New Zealand's economy is in worse shape than expected, with the GDP slumping by 0.9%. So what does this mean for the market outlook? Joining me now is Zoe Wallis, Forsyth Barr Investment Strategist. Thanks to our partners, Forsyth Barr. Well, the Fed has announced its first rate cuts in 9 months, and last week we saw the New Zealand GDP decline further. So Zoe, what does that mean for the global outlook?
Yeah, look, so I guess starting with the Fed decision last week, that was very much hotly anticipated. The market has very much seen it as opening the door now to a rate cutting cycle from the US Federal Reserve. That did provide a bit of a tailwind for US equity markets towards the end of last week, just on that hope that, further policy easing really does help support the global financial markets, particularly the US equity markets. But we're also still seeing a lot of enthusiasm coming through around potential AI developments, what's happening with the AI tech sector, and that's where you're seeing a lot of the positivity. Although it is worth noting that we are seeing some of the small cap names also in the US performing better on the back of that expectation of lower interest rates means a more buoyant economy and more local spending. Okay. Switching, I guess, over to New Zealand GDP data last week. Look, as you say, that very much did highlight that the New Zealand economy is not in a great spot, or certainly wasn't in a great spot through the June quarter with the economy contracting. If you look at where we are heading over, the second half of 2025 so far, things are looking a little bit more positive to date. A few of those more just cyclical turnaround signs starting to come through. Monetary policy operates with a lag. It takes a while to get going. But for equity markets in New Zealand, what we are seeing is that, we are a highly interest rate sensitive market. And with the economy where it is likely that the RBNZ may actually end up doing a bit more work in terms of cutting interest rates this year than we previously expected. Yeah,
so where do you think it's going next in terms of cuts to the OCR? What's the predictions for the next development on that?
Yeah, so look, I think following that GDP data last week, everyone was sort of reassessing the forecasts, us included. So we now do expect the Reserve Bank to cut by 50 basis points in October. There's a couple of things behind that. So one is obviously the weakness that we're still seeing coming through domestically. The other is that when you think about where the RBNZ was at their last decision, you actually already had a split committee vote with 2 people in favour of a 50 basis point cut. So I think that latest GDP data is probably enough to convince them that it's time to get some more runs on the board and quite quickly.
Yeah, so what does the shrinking GDP mean for people with home loans? And what's the sort of future outlook, I guess?
Yeah, look, I guess with the economy in a weaker position, what it does mean is that the Reserve Bank has more work to do, essentially. And that means further reductions in the short-term official cash rate, and that does feed through to what happens with mortgage rates across the curve from the retail banks. You're already seeing a little bit more downwards pressure in what we call the wholesale interest rate market, and that's largely what the retail banks set their mortgage rates off. So what you can see is that as wholesale rates come down, it makes it easier for banks to start cutting their mortgage rates as well.
So when, Zoe, do you think that, what's the chat in your office about the state of the economy right now and investments? At what stage are we going to start to see an improvement in your mind? Is it going to go beyond 2026, or are we going to start to see significant improvement in the latter half of this year?
Yeah, look, I think what has been really characterising the domestic economy has been it's been very patchy, and you can see this coming through across the country when you look, Auckland, Wellington really subdued, you get further south, more and more positive. You're seeing the good positive side effects from things like, the Fonterra payout last year, better payout this year, and a windfall from the sale of the consumer business coming through. You can also see, generally things like meat prices and horticultural sectors are generally doing quite well. Tourism's coming back, particularly strongly down south, less so in the North Island, but that's certainly providing a tailwind for the southern economy. So there's these areas that are doing really well. And then what was really clear is that manufacturing and construction sectors are still really suffering and doing it tough. Now, hopefully some of that was temporary due to what happened during the June quarter around global trade policy and tariffs, huge amount of uncertainty generated off the back of that. So we are seeing that uncertainty settle down and businesses feeling a bit more comfortable getting on with things. We now know where our tariff rate is set from the US perspective, and that it doesn't seem to be having a materially negative impact on the sector as a whole at this point in time. And so we are starting to see a little bit more confidence as well coming through in things like retail sales. When you look around the country, a bit of a pickup there, and just generally a bit more positive sentiment expected to come through on the back of those lower mortgage rates and interest rates coming through over the next few months.
Yeah, positive sentiment. That's what we want to hear, Zoe. Zoe Wallis, investment strategist. Thanks to our partners at Forsyth Barr.